All right, welcome to Bourbon and Real Estate. We are doing this again. It's been a while.
It has been a long time for me.
We've got a bottle of Dark Arts, the 7-year rye, and one of our favorites.
Hands down.
It's an MGP product, but we've got the Masters on, and we were just going to talk a little bit about what's going on in the market. So it has been a whirlwind, if you will, the last week.
Yeah.
Economy's obviously been doing the yo-yo. So have mortgage rates. So I wanted to talk about, what are your predictions for this year? Do we even have a prediction for this year? What's affecting, talking about the bond market and how that affects mortgage rates? Is it behaving the way that it typically does? And just want to talk and get your guys' opinion because you've been doing this forever and you've seen a little bit of everything. So
on to the old guy thing already.
I'm looking at Berger to let him.
You both have more hair than I do, so.
Yeah, well, from my historical perspective, the bond market's just not acting correctly in my mind. It usually rallies, which means the rates go down when the stock market crazy stuff. It's April 10th today, so we've seen the last week crazy stuff, and the bond market stood in there, and we haven't had any rate kind of relief.
No, last Friday, I think you had a window of, oh shit, this is the time to refinance.
It was Thursday. And obviously I wasn't in town, even though, I kind of work when I'm not in town, and phone ringing off the hook. I wasn't paying that much of attention because I wasn't kind of in an office setting. So I had to start looking, and I was like, well, this may be, I even said to several people that were there that were from Prime Lending, maybe this is the window. And then by the next day, Friday at noon, 2:00, we were repricing to the worse, and and what I had told everybody that had hit me on Thursday, let's let it stick. If we're still here this time next week, we're probably going to start to see some improvement. And not only didn't it stick, it kind of blew up and went the other direction.
Right.
So rates today are...
And again, rates are not one size fits all, but your premium stuff today... Yeah, and it's, because they're not. And we all know that they're not. But I'm going to say your conventional stuff, your late 6, 7-ish, maybe hanging on still to where maybe mid last week we were thinking more mid 6, 6 and 5/8, 6 and 3/4 kind of a move. And so rates still, I would say, if you look at the last 45 days, right where they've been.
Sure.
You see my weekly update that I put out. We were getting into that 663 average windows, 659 maybe even on one of the updates. And had I put my update out yesterday before noon, the update that I put would have said 701. I waited because the market had corrected a bit and it was 695, I think. So it still kept it. I think I had 9 weeks in a row in the sixes, which is what I was hoping for. I'm always big on trying to make the updates a glass half full.
Right.
Kind of let's keep it positive because there's nothing we can do about it. Yes, but it's been a weird market for sure.
If you guys are not getting Rob's updates, I'm going to put his number on the screen right about here. And you should text him and say, hey, put me on the updates because they are weekly, good synopsis of what's going on in the market. More basic version of kind of what we're doing right here, but talking about glass half full. Here's what to look optimistic about. But we have a little resistance here, here, and here. So definitely sign up for those. What do we see going forward? We've got a 90-day reprieve from tariffs, except for China. What does that mean for mortgage rates in that 90-day window, and what does it mean thereafter?
Haven't changed that lick in the last day, have they?
Mm-mm.
So, we got that big relief rally yesterday and didn't do anything, and that's what's weird. So my question to you, because if you are familiar with the numbers, the coming and goings, the earnest months and things like that, is this a normal spring market?
Yes.
Well,
yeah,
that's amazing.
It's right in line with 2023.
Okay.
Normal meaning by buyer sales and listing happening?
Just general activity in the market.
Our 24 was better than our 23. 23 was a tough year.
Mm-hmm.
That was the first year you stopped seeing multiple offers in 12 hours, right? We had the blessing of 20 and curse of 20 through 22, which was just bananas.
Yes, stupid.
So then we took a little backseat in 23. Things kind of rebounded in 24. I think we're pretty consistent. But you're still looking at overall big grand picture of everything is we only had 4 point whatever million homes sold compared to 5 million, 6 million. If you're hitting 6 million, the market's cranking, or something's wrong.
Right.
5 million is definitely the wheelhouse that we want to be in. I don't think we're going to hit 5 again this year.
Probably not.
I would love to see us be closer to 4.6, 4.8, but I still don't even think that. I think that's optimistic. Unless rates bounce down because of something like we saw that little rate reprieve, get them down in 6.5. I think you're going to see some people get off the fence.
I would agree.
You still have a lot of people PCSing, but you have a lot of people that are taking the early out and not moving between bases because they don't want another move. So,
yeah, and I think the mentality, and we talked about this a little while ago. The mentality is what is the rate window where it creates activity?
Makes a difference
because it's 5.8.
And I would agree because you're saying the 5, but there's so many people too. I still think that have been around through only the good of a market that think great rates are 3 and 4. I mean, unbelievable rates for 3 and 4, and we may never see that again.
The average rate for the last 40 years has been what?
Well, as we discussed, take out mid 80s, take out 2020 to 2022, 6 and an eighth. We're within a half to a point from
or the average.
What the averages is, kind of like buying gas, buying anything. That's if you could buy it on the average. When gas was $5 a gallon, everybody would kill for the average.
Sure.
When rates went to 8, everybody would have killed for the average. But now some people, I don't know, at 6, maybe not, maybe. And I'm like, if you're at 8 and an eighth and you can get 6, there's no maybe to it.
When I get any relief, I'm sorry. If we get any relief, it's not going to be much.
No, we would, I think, all kill for 6 and an eighth right now. 5.8 is the number that home builders have determined they need to have in order to get buyers off the fence.
Get people excited.
So they're buying down the rate, offering their package incentives, etc. I don't see that happening this year. Excuse me. We talked about Fed rate cuts. They're anticipating some rate cuts. 2, 3.
You know me on the rate cuts. I'd still say they should have
not done it.
Their hands was. But
you owe me a Fleming's dinner.
I know. I owe like 30 people dinner because, and what stinks in that is that after they cut on the 18th of September, by October they knew they shouldn't have. I don't care what they say. They knew they shouldn't have. They did the rest. They did the point. Was it October, November, December? They did the cut to make it the 1 point that they said. I still say the Fed shouldn't have cut last year. I don't think the Fed should cut this year. And I say that by the fact that I'm not sure what you get out of a Fed cut. I get that the credit cards get cheaper. Maybe that sparks some economy. Your home equity line gets cheaper. But as we saw in September, October, and November, or whatever this cut was, every time they cut last year, rates went up.
Yeah.
And which is always happens, but then it usually settles, and we never got to settle.
Well, we always see that anticipation to the rate cut. That's when rates drop, and then you see it bounce.
It's more psychological. That rate cut doesn't do anything to the 10-year.
Right.
It really is more, it's more credit card, prime rate, that kind of stuff. But the 10-year is a whole different animal, and it marches to its own drum. So, for years it's been 2.5 plus the 10-year is what your 30-year mortgage rate is. That has not changed, like you mentioned earlier. It's like,
and that's right where we're at right now, because everybody keeps saying that the 10-year Treasury this year will probably hover somewhere at best in the 3.5 window. Would you agree? If we can keep it under 4,
best.
So add your 2.5 to the 3.5.
Right. And for people watching or listening that don't know what that means, back up and explain that real quick.
Well, the 10-year Treasury for 30 years has been a great barometer of where rates are headed and where they've gone. The rule of thumb has always been if you add 2.5 to 3 to the 10-year Treasury, and you can go to any business webpage and call up bonds and look at the 10-year Treasury, add 2.5 to 3, and you're going to be within an eighth give direction of what rates are. Today, we're at 4.2 on the 10-year.
4.
We're at 4.
Yeah.
Okay, so add 2.5 to 3. That's 6.5 to 7. That's right where rates have been. So if the Fed are the geniuses that think we're only going to get down to 3.5-ish at best this year, add 2.5 to 3.
Right.
And you see, we're still 6.5. Yeah, we're not in that 5 window without the reality of getting into a 3 kind of a 10-year Treasury.
Right.
Yeah.
And if you historically track the 10-year Treasury, the 2020-21, when it was, I think the lowest I ever saw was 0.53, which is beautiful. I had 2.5 to that, and it was just, and we were printing money, obviously. If you look at a historic window, that had never happened before. And I don't think under 2 to 2.5 is normal. Is it Berger over a 30-year history?
No.
So when it was nothing, because the Fed level was zero, because of COVID, they had cut the Fed down to zero.
Yeah.
I don't know that we're ever going to see that again.
No.
So
no.
So what? I mean, again, you guys are old. No, I'm kidding. What happens if the economy tanks? I mean, tanks. We've seen crazy stuff in the stock market over the last week. And I don't want to play devil's advocate. I'm not picking, this isn't political at all. I just want to know what happens if the economy cuts by 20%.
And you're talking economy, meaning the stock market?
Stock market, sorry.
Okay.
That's when you see some rate cuts, because they'll be printing money like crazy. And
trying to stimulate the economy.
See it. The 10-year will react. It hasn't reacted to this, but there's just some sparring now. You see a butt kicking, and yeah, you will see 0.5% or 1% rate decrease.
And to Rob's point, I mean, we're in the situation we're in now because rates were too low too long.
Mm.
That's why we had 30+% appreciation happen in 1 to 2 years. I think I just saw a chart yesterday that said Ohio's appreciation over the last 5 years was like 50%, which is insane.
Wow.
That can't be.
It's not sustainable, right? It's got to retract.
I like it though, currently.
Well, yeah, if you sell now.
Right. Right. Well, that's true. I'm not selling, so I guess it doesn't really matter.
So again, to the market question, are we still seeing in our more preferred areas or some of our suburbs, are we still seeing multiple offers?
Yes. Saw it in the last week.
So instead of 4 offers, you're only getting 2?
No, I saw 4.
I'd say
instead of 12, you're seeing 4.
I was getting ready to say the same. And we're seeing that with buyers that aren't winning.
Yeah.
Because I'll hit them the next day. Hey, how'd the offer go? Oh, we got beat out by a bid that was $20,000 over.
And we're still
hearing
seeing
that.
a ton of cash.
Yeah, and I obviously don't see the cash price of it. But I will say that I don't have anybody pre-apt right now that isn't buying what they want because of rate. The rate shock part of it is long gone.
Yeah.
People are now used to rates being 6.5, 7.25. Mm-hmm. It's just the norm.
The difference is affordability, because appreciation happened. You know, somebody that used to qualify for a $350,000 house now doesn't.
Right.
And that $250,000 house is a unicorn.
Yeah.
Right. Yeah, you're first time buyer more than anybody else is.
Yeah.
But I think the biggest thing we need on the rate differential is your sellers not selling to become buyers.
Yeah.
I've noticed a normal market for buyers. How many pre-apps I have in the drawer at this time. And obviously the drawer, since that's an old school thing, but nonetheless, I have as many people pre-apped right now as I ever do in a spring of any given year. But most of those are newer buyers. A lot of those are not repeat. I can't tell you how many people we pre-app and they're like, well, when rates come down, I'm going to kick around sell. And you and I've talked about this too. And those are the people that we need a 5 7/8 rate for, because then I think you have your people that want to downsize or upsize. Then I think that they will. And, you know, because if you were especially downsizing, it doesn't make any sense to downsize right now and add 4% to your rate. You're going to spend more because of appreciation.
Move down, move your payment up.
Yeah. I'd be buying the same house price-wise that I bought now.
Yep.
Much smaller and a higher interest rate.
You're better off to put in the elevator or the stair lift if it's because you can't do the stairs. There's a lot of things, and I think that's the mentality that I think rates in the 5s will break.
Well, and you had, a couple of the analysts talking about the silver tsunami that's supposed to happen. I don't see it happening. I just don't. People are staying in their homes longer to the point where they shouldn't be.
I'm not moving.
No.
I mean,
Same. Why would you?
It's exactly.
You will. You got 2 levels.
Well, I've already scoped out the spot where the elevator goes.
Sure.
I'm telling you, with what we've done to our house, other than the stairs being older, and again, obviously I was 60 this past week. I figure I've got another good year or 2 before I can't get up the stairs.
Are you going to have a secret compartment in the elevator with a bottle of bourbon?
Yeah, just something to get me up and down. But we like where we live and we like our house. I like my 11 years left on my mortgage at 2 1/8 rate. Again, even if rates were 2 again, I'm not moving. But there are a lot of people that would probably that would downsize. I probably have family members that would downsize if the rates change.
So we got 2 components that are still kind of locked up. The first-time buyers have gotten closed out, which I hate.
Right.
And the maybe I will, maybe I won't buyers are going, I'm not doing it. So we still have our middle left, but
you have, I think to that same effect, you have the sellers that are, hey, I'm not moving because my interest rate's great. I'm happy with my house. There are things I'd like to change, but you know what? Yeah, make me move.
And those are the people that are doing a home equity line of credit
and fixing up their house
and doing a new kitchen and putting a pool in.
Sure.
And, and it's, it's the mentality of that. But yeah, other than my house being a 2-story, and I'd like to have a basement because the weather's not getting any better either.
But you're seeing what I predicted a few years back come to fruition. You're seeing builders build in neighborhoods or areas that they otherwise weren't. They were focused on the higher end neighborhoods or cities.
500,000 all day long,
And now they're building $600,000 to $700,000 houses in those neighborhoods, but they're building not 250. If we could get a builder to build at 250,
yeah, all day long,
they would be gone in a heartbeat, and you'd see all these buyers get off the fence. But they're building in that 350 to 400 range. Mm-hmm. In your Zinnias, your Fairborns, your New Carlisles, you're seeing them build in areas where there's land available. And I think that does open up possibilities for a lot of buyers. What is interesting to me, looking at this on a broad scale, is to see how that affects school districts. So I don't want to get into fair housing by any means, but I think you're going to see affluent districts age out because A, they're cutting funding for schools, etc. Mm-hmm. B, you're seeing a lot of new money coming into less affluent areas historically, mm-hmm. That are, hey, they're there to support their kids and doing all these different things. Those areas are growing like crazy, and schools are getting better.
Mm-hmm.
So,
hope it evens out. You know what I mean?
Yeah. I mean, none of us can control it, and that's one thing I don't lose a lot of sleep over what I can't control. And I just know one day you want to look at your 401k, and one day you don't. And you actually, unless you're retiring soon, you're better off to just stay out of it. And it's tough to do. And it's like the train wreck. You can't take your eyes off of it.
Right.
I made the mistake last Wednesday or Thursday of grazing into it, and it didn't make me feel any better. So I don't know why I did it, but nonetheless, it was more of a curiosity thing. But then after a day like yesterday, up 2,300 on the Dow, up 6%, 5% on S&P
right now.
So I know, and so I was like, okay, I got back.
Don't look at
a third. I know, you just leave it alone, and it's kind of the same thing with rates. We wake up each day. If rates are 6.5 to 7, then if you want to buy a house, that's what it is. If gas is $3, everybody should be loving gas right now. Oil's about $68 a barrel, which is right in the economic window for the world economy of 65 to 85. They say is the window. And remember when gas was $4 and $5. So I think it just ebbs and flows on what you enjoy and what you don't.
I haven't bought gas in 3 years. So
I was going to say, I don't know. I don't know how, I can't do gas anymore. I don't know how to do work.
You haven't bought, yeah. You've probably got.
Peasant have fun at that gas station.
Yeah. Yeah.
So summarizing, if you're going to do something this year, there's no reason.
Don't try to play the weight.
No.
The rate game.
No. I think you're waiting for Godot on that one. And if you get a quarter, cool. If you get a half, cool. But there's no.
Well, and it was I think it was a cheesy kind of approach to date the rate when things were 7.5, but a lot of people did, and they refinanced for 6.5.
Yep.
Because they found that window. So, yeah, I think,
And there's a few that we did refi in September.
Yeah.
That had been in that prior 8 window, and they benefited from it, but it went away so fast, we didn't even, we couldn't get everybody caught up fast enough. And some people didn't want to lock.
Sure.
Because they thought it was going to keep going down. And so those applications were in vain because they just ended up dying on the vine because the rates went away.
Yeah. Yeah.
So.
Cool.
Yeah. It is what it is.
Last thoughts on what the market's going to do?
I have a feeling that we're not done with the trepidation yet in the overall market, and that we will get some bond relief. We will get some mortgage relief probably between now and this summer. But I don't know how much.
I think that will happen, and you will be back to not 4 offers, but 8 offers. I think it's going to get more buyers off the fence, more sellers off the fence.
So it's just shaved a little bit of the off of the sheep, and the sheep is still fat and fluffy. In some areas, obviously.
Well, you're definitely seeing things sit on the market longer in certain areas, in certain price ranges. But that 350 price range is hot, and things are moving quick.
And where's it start leaning out? 5?
Yeah.
350 to 5 is still the come and get your love.
Yeah, 300 to 400 is hot.
Well,
it's the new 2 to 250.
And that's from your viewpoint, Indiana,
Ohio, Kentucky,
northern
Indiana.
Ohio, and southern Ohio and northern Kentucky. Okay. Yep. All right. That's a lot of area. And
I mean, you pull our average price range, our average price 2024 was $292. So
that's about right.
Yeah.
So
I remember when it was 126.
I remember when it was 5 digits, not 6. So so we've all benefited.
That's when Mark Berger was like #1 in Greene County.
It was. I remember that.
A long time.
I think I was trying to graduate high school when Berger was #1 in Greene.
We're getting personal.
All right, let's watch the Masters and have another drink. But thank you guys for watching. We'll see you on the next one.